Welcome to the ultimate guide to candlestick patterns, episode 4. In the previous episode, we examined reversal candlestick patterns, and in this episode, we're going to talk about continuation candlestick patterns, the patterns that form in the middle of a trend and they indicate that the trend is likely to continue. Stay tuned and let's get started. The most simple formation on the charts that shows possibility of continuation is a gap, and it's a base for some other continuation candlestick patterns that I'm going to explain in this video. When the gap is between shadows, for example in an advance, when there is a gap between first candle upper shadow and second candle lower shadow, it's called upside gap. Or in a decline, when there is a gap between first candle lower shadow and second candle upper shadow, it's called downside gap. Japanese call it window, and they use the expression closing the window for filling the gap, and when the price doesn't fill the gap, they use the expression open window. So based on where the gap forms, we have two kinds of windows: rising window when the gap forms in an advance, and falling window when the gap forms in a decline. Gaps generally show increased pressure in the direction of the gap, so when we have a window in the middle of a move, it shows the possibility of continuation. Also, gaps generally act as support and resistance areas, so when, for example, we have a window in an advance, the window plays as a support zone in the pullbacks, and when we have a window in downtrends, the window plays as a resistance zone in the pullbacks. Usually, a test of windows happen that can provide us a good opportunity to enter a trade in the direction of the trend. Just pay attention when the pullback closes the window, or in other words, fill the gap. The game may change. For example, in an advance, if the pullback closes the window and after that the selling pressure continues, we can say that the uptrend is possibly ending and the bears are in command now. Or in a downtrend, if the pullback closes the window and after that the upside move that closed the window remain in higher pressure in compared to downside pressure, we can say the downtrend is possibly ending and the bulls are in command. In previous episodes, if you remember, we examined some reversal candlestick patterns that were like this. If you haven't watched those episodes, I recommend you to watch them later and learn those patterns so you better understand how the gaps can also play a role in reversal patterns. Alright, the first pattern that I want to explain is called Tasuki gap. We have two kinds of Tasuki gap: upside Tasuki gap and downside Tasuki gap. Downside Tasuki gap forms in downtrends and it shows the possibility of continuation for the downside move. The first candle is a medium to long red candle, as you expect for being in a downtrend, and the second candle is another red candle, short to medium, that forms with a downside gap. In other words, there is a gap between the first candle lower shadow and second candle upper shadow. As I just explained, that's called window. A window forms on the chart. The third candle is a green candle that is open in the body of the previous candle, but it's not able to close the window. In other words, it cannot fill the gap and the candle closes below the first candle body, and this shows that while the bulls aggressively opened this candle with a gap in the body of the previous candle, but they were not strong enough to fill the gap. If you remember, I said windows plays as resistance level in downtrends, and this shows that bulls were not able to break this resistance level, and there is more possibility for continuation of this downtrend. And upside Tasuki gap is exactly like downside Tasuki gap, but in the opposite direction. It forms in uptrend and it shows possibility of continuation for the upside move. The first candle is a medium to long green candle, and after that a short to medium green candle forms with an upside gap. In other words, a window forms on the chart. And the third one is a red candle that opens in the body of the previous candle but not able to fill the gap, and the candle closes above the first candle body, and this shows that the bears are not strong enough to break this support level that is made by the gap. This shows that the uptrend is likely to continue its upside move. Another continuation pattern that is based on windows is called side-by-side white lines. Bearish side-by-side white lines forms in a downtrend, and it shows that the downtrend is likely to continue. The first candle is a medium to long red candle, and the second candle opens with a considerable gap below the first candle close, but the bulls step in, and take the control of the price, but they are not able to fill the gap, and the result is a short to medium green candle, that there is a gap between the two candle shadows. In other words, a falling window forms on the chart, and the third candle again opens with a gap, a down gap approximately in the second candle opening price, but again the bulls step in to try one more time to fill the gap, but no success, and again the candle closes approximately where the previous candle closed, and this shows that the resistance level that is established by this gap is significant, and the buying pressure is not strong enough to break this resistance level, and this indicates that this downtrend is more likely to continue. And bullish side-by-side white lines is similar to the bearish one, but here the pattern forms in uptrends. The first candle is a medium to long green candle, and the second candle is a short to medium green candle that is open with an upside gap, meaning that the two candle shadows don't touch. In other words, a rising window forms. The third candle opens with a considerable gap approximately at the opening level of the previous candle, but the bears are not strong enough to go lower and fill the gap, and the bulls step in and push the price up, and the candle closes at the level that the previous candle was closed. This shows that the support level established by the gap is significant, and the selling pressure is not strong enough to break this level, and the continuation of this uptrend is more possible to happen. Alright, the next pattern I want to explain is called separating lines. We have two kinds of this pattern, bullish and bearish. Bearish separating lines forms in the middle of a downtrend. The first candle opens with a considerable gap below the last candle close, and at first when this candle opens it may show excessive selling pressure, but after that the bulls manage to take the control and push the price up significantly, and a medium to long green candle forms on the chart. But suddenly we encounter a very high selling pressure. The next candle opens with a considerable gap approximately at the opening level of the previous candle, and the bears remain in control and push the price down significantly, and a red candle approximately same size of the first candle forms on the chart, and this shows that the selling pressure is much higher than the buying pressure, and the downtrend is more likely to continue. And bullish separating lines is mirror image of bearish separating lines. This pattern forms in the middle of an uptrend. The first candle opens with a considerable gap above the last candle close, but in this session the bears took the control and pushed the price down significantly, and we get a medium to long red candle. But suddenly, with a very high buying pressure, the next candle opens with a considerable gap approximately in the opening level of the first candle, and the bulls remain in command and drive the price higher, and the result is a medium to long green candle. This pattern shows a very high buying pressure, much higher than the selling pressure, and this gives the possibility of continuation for this uptrend. And the last pattern I want to explain is called three methods. Falling three methods forms in the middle of a downtrend, and it shows that the downtrend is likely to continue. The first candle is a long red candle, and after that we have three small to short green candle, not necessarily with the same size of bodies or shadows, but three of them must be in the low to high range of the first candle. And finally we have a long red candle that is ideally open in the body of the last green candle and closed below the first candle low. The three green candles show that the bulls are not strong enough to drive the price to higher levels, even higher than the first candle high. And with the last candle, which is closed below the first candle low, it shows that the selling pressure is higher than the buying pressure, and the downtrend is more likely to continue. And rising three methods forms in an uptrend, and it shows the possibility of continuation. The first candle is a long green candle, and after that three small to short red candles form, that three of them are in the low to high range of the first candle, and these three candles show that the bears are not strong enough to push the price lower. And when the last candle, which is a long green candle that closes above the first candle high, it shows that the bulls are in command and we have higher buying pressure in compared to the selling pressure, and this indicates that the uptrend is more likely to continue. Alright, in this episode we examined some common and reliable continuation continuation candlestick patterns, and I explain how you can correctly identify and interpret them to realize if the trend is likely to continue or not. Thank you for watching this video, and I hope it has been helpful for you. If you found any value in this video, please like it, please subscribe to my channel if you haven't already, and hit the bell so you get the notifications of my new videos. See you guys in next episode, and good luck with your trading.